One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. My name is Alex Mason and I am your host. Thank you for joining me. I'm recording on the road again today, and I wanted to make sure that I brought you another episode, another technical topic. So we've been discussing this concept of deferred tax liabilities and deferred tax assets. And I gave you an example yesterday about how a deferred tax liability would impact the balance sheet of a corporation when the business combination takes place. But today's question is just looking at the other side of that. How do we deal with deferred tax assets? And how do they affect the balance sheet? That's the question. How do deals with deferred tax assets affect the balance sheet? So we talked about DTLs. Specifically, we walked through what happens in an all-cash deal when there's a write-up to an asset that creates that deferred tax liability. But let's get some more practice in with this today and do another slightly more complicated example. This time, we're going to assume a couple of different things. We're going to assume, first of all, instead of a write-up, we're going to have a write-down of an asset. And we're also going to assume that the consideration of the deal is different. So instead of an all-cash deal like we did yesterday, we're going to do a 50-50 cash deal and debt deal. So 50% of the purchase price is in cash, 50% in debt. Okay, so let's get into this example. Let's, like we always do, state our assumptions up front at the beginning of the problem. So let's assume deal is 50-50 cash debt, and let's assume that the purchase price is $1 billion. Now, let's also assume that it's agreed upon during the transaction, we're going to be writing down an asset by $100 million. And let's also say that the tax rate is 40%. Okay, now looking at the target company, the seller, let's assume that they have assets of $200 million and total liabilities of $100 million, which gives them shareholders' equity of 200 minus 100 is $100 million. All right, so those are our assumptions, and let's go ahead and think about how the balance sheet is affected with this deferred tax asset. So we know that the target's assets are 200 million. So we add that to the asset side of the balance sheet. We also know that the target's liabilities are 100 million, so we're going to add that to the liabilities side of the balance sheet. And just like last time, we're not going to add shareholders' equity because this gets wiped out in the acquisition. So now at this point, we've added the 200 million in assets, we've added the 100 million in liabilities to the balance sheet. Now we're going to account for the asset write-down. So let's say that a factory was purchased, it's actually being written down to be worth less than what it is on the books. So now that creates a deferred tax asset. But before we account for that, we're first going to actually account for the write-down itself. So the write-down itself is $100 million. So that amount is going to get subtracted from the asset side of the balance sheets. Okay, now here's where the deferred tax asset comes in. So you multiply the $100 million write-down by the 40% tax rate to get $40 million. Now, because this is an asset, this gets added to the asset side of the balance sheet. And then last but not least, we have to account for the deal structure itself. So instead of an all-cash deal, we're doing 50-50 cash and debt. So this $1 billion deal is going to get broken up into the two components, $500 million in cash and $500 million in debt. So cash is an asset. So we have to subtract $500 million from the asset side of the balance sheet. And we know that debt is a liability. So we add $500 million to the liability side of the balance sheet. So let's go ahead and put all these things together. I know I just threw a lot of numbers at you for various reasons, but I wanted you to understand the breakdown of how this all works. So when it comes to these adjustments, let's first look at the asset side of the balance sheet. So first we have an increase of $200 million because of the assets from the seller. We have a subtraction of $100 million because of the write down. We have an addition of a positive $40 million because of the deferred tax asset. And then we have a subtraction of $500 million because of the cash component of the purchase. So if we do that math, 200 minus 100 plus 40 minus 500 is equivalent to negative $360 million. So that's what we have on the asset side. Now, if we look at the liability side, it's pretty simple. We just have the 100 million that we have increased from the seller, that getting transferred over to the liability side of the balance sheet. And then we also add in this 500 million for the debt component of the purchase. So 100 plus 500 is equivalent to 600 million. So now on the asset side, we've got negative 360 million. On the liability side, we've got positive 600 million. And assets have to equal liabilities plus shareholders' equity, which means that the goodwill in this scenario must be $960 million. And then the balance sheet balances. And that's it. That's how you get to the goodwill. That's how you account for this deferred tax asset as a part of this transaction. And that's really it. And just so you understand what's going on intuitively here, we have this $1 billion transaction, but the target, it really didn't have a lot of equity. It only had shareholders' equity of 100 million when it was being purchased. So intuitively, there's going to be a lot of goodwill there, right? Because purchase price of 1 billion, shareholders' equity of the target is only $100 million. So that's going to create a lot of goodwill. And in fact, it did. It created $960 million of goodwill. We're basically just accounting for that deferred tax asset that's a component of that. So that's kind of how I think about it from the intuitive sense, in addition to actually working through the math too. Okay, so thanks for sticking with me through all those numbers. I hope you enjoyed that. Hope you learned something today. This has been Investment Banking Insights. My name is Alex Mason and I am your host. And I hope you have an amazing, truly awesome day. Thank you and take care.